A subscriber requested an update on metals valuations. It's been a few months since I've done one, and so it's time to take another fresh look. But first, let's take a look at what I suggested in my January valuations update. If you recall, at the beginning of this year, gold was about $80 per ounce higher than it is now, silver was about $1 an ounce higher than it is now, platinum was $120 an ounce higher, and palladium was $30 an ounce higher than it is now. I was a little concerned at the time due to the low and declining price of oil, as well as other commodities such as coal, iron, and cement, signaling a general strengthening in the dollar and the subsequent drag that it could create on the metals. I suggested at the time that new purchases of precious metals be delayed and that extra cash could be used to pay off debt and maybe used to buy some US savings bonds as a way to keep some cash handy for later. In hindsight, my call was a good one, even though I drew quite a bit of criticism from one particular YouTuber who runs a paid subscription service. The dollar price of all precious metals has weakened since I made my beginning of the year update. In addition, the downward price trend in oil seems to have subsided, and oil is now $12 per barrel higher than it was then. Now, I'm not making any claims of having made a great call. Nobody ever knows what the future has in store. If anyone pretends to know the future with certainty, run away, far away. And if they should want to charge you for their advice, then run away fast. The best we can do is use some historical metrics and determine what should happen in the future. And though the probable future may not unfold according to our preferred timeline, it will at least stack the odds of success in your favor. And the approaches that are the most likely to work for you can learn for yourself so that you don't need to pay anyone to give you advice. So with that in mind, I'd like to start this update by rehashing my methodology for the benefit of new subscribers and as a refresher for those who have been with me for a while. If we take a look at the past 45 years of history, when gold has been completely decoupled from the dollar, we can see how 4 precious metals have been valued relative to oil. I pick oil as the standard by which I measure value because there is no commodity that is more crucial for the functioning of the world economy than oil. In addition, production of precious metals is a very energy-intensive business, and so the cost of producing the precious metals should track the price of energy. When scaled properly, we can see that the prices tend to be range-bound. An ounce of gold will buy somewhere between 10 and 25 barrels of oil most of the time. That's not to say that it can't go outside of this range, but when it does, it doesn't do so for very long. Towards the top of the range, the metal can be viewed as expensive, and towards the bottom it can be viewed as cheap. The closer you can buy to the bottom, the more likely it is that by holding the metal you will preserve or possibly increase your wealth. The other metals have been generally range-bound for the past 45 years, with the exception of palladium, which went through a price bubble in the years surrounding the turn of the millennium. Many bought palladium at this time, and it turned out to be a very unhappy experience for them. But in general, 63 ounces of silver, 0.8 ounces of platinum, and 2.4 ounces of palladium all tend to behave like an ounce of gold, and so we can use this as our valuation tool. Just as an example of how we can use this tool to our advantage, consider the April 2011 price spike in silver, where silver had doubled in price from the beginning of that year. According to the historical price range, silver reached the overvaluation range in that month at $49 per ounce. Meanwhile, the other metals were much more fairly valued. While it was entirely possible that silver could have continued its price run, the odds were that it would go back and rejoin the other metals. And while the price of all of the metals declined due to a strengthening of the dollar over the past 4 years, it was silver that fell the hardest. For example, while silver fell in price by 67%, gold only declined in price by roughly 20%. So knowing the relative valuation of the various metals can help you to avoid making big mistakes, such as being weighted too heavily towards any one metal when it is unreasonably expensive relative to the others. Now, before we use this data to discuss where the metals currently stand relative to one another, let's discuss one particular limitation to this approach. I use the data from the past 45 years for valuation because it's a very rich data set. lots of data is available. In addition, it was a time period when none of the metals were used in any official fashion for monetary purposes. Thus, the past 45 years is the most similar to the conditions seen today. By contrast, we know that over a much longer period of time, the role of gold and silver have changed. Both used to be used officially in the monetary systems of various world countries, and so their valuations have been different over longer periods of time. And let me show you that. Here I show you the ratio of 1 ounce of gold to 1 barrel of oil and 63 ounces of silver to 1 barrel of oil, going back to the year 1876. It's nearly a century and a half worth of data. Now, I only have yearly data going earlier than 1968, as opposed to the monthly data that I have afterwards, but the data that I do have here is still useful. What we can see is that the trend of gold relative to oil has been very stable for a full century and a half. Thus, despite the abandoning of gold for official monetary use, its pricing relationship to oil has been very stable. This would suggest that even though the governments of the world don't acknowledge it, gold is still used as a monetary asset and a store of wealth for the most powerful and influential of the world's interests. Silver, by contrast, has been gradually declining in value relative to oil since the Coinage Act of 1873 redefined the dollar in terms of gold rather than in terms of silver. This decline in valuation is not a short-term trend. It has persisted for a century and a half. Is the decline over? Well, it's hard to say. The value of silver has been fairly stable over the past few decades, and so I think that the decline is over, but I don't know for certain. Will the trend change? It might, but I think that such a trend change would have to be as a result of the world viewing silver as a monetary asset and a store of wealth once again, and not primarily as an industrial commodity. So all else being equal, I view recent silver valuations as being more relevant than the longer term. With that said, let's talk about where the metals stand according to the past 45 years worth of history. Here I've plotted in white bars the current spot price of the various metals in terms of oil. We can gain from the spot prices some insight into how the metals stack up relative to one another in terms of valuation. Unfortunately, you, the retail investor, are not able to buy the spot price, unless of course you're very wealthy and would like to own a paper claim rather than the real thing. No, you, the retail investor, are most likely going to go out and buy a coin, or many coins. I recommend low premium sovereign coins, and the reasons for this recommendation I've gone into in past videos. Given that you are most likely going to own the metal by purchasing coins through an online broker or through a local coin shop, I also plot the ratio to oil using the prices available on Canadian maples. The reason why I chose the maple is because it is available in all 4 of the metals and tends to have low premiums relative to the other coins. We can see that while retail gold is a bit on the expensive side, it's not above the 25 barrels to an ounce that it was in the beginning of the year. Is it cheap? No. But neither is it horribly expensive at this point. As far as silver goes, the spot price makes it seem like silver would be a good value here. The actual price of the coin with the markup tells another story. Any advantage the investor would gain from a favorable gold to silver ratio is all but eliminated by the premiums being charged. So, from the standpoint of valuation, I view gold and silver to be a wash here. Does this mean that silver can't outperform gold? Not at all. But personally, I favor gold to silver for a few reasons, most of which I've covered in my other videos. Platinum offers a much better bargain than silver at current prices. Platinum currently trades at a 20% discount to gold, and that includes the premium on the coins. It's an industrial metal just as silver is, but it has the advantage of being much more compact and value dense. You can store a lot more wealth in a small piece of platinum, which is an advantage that should not be overlooked. Finally, we have the trend follower's favorite metal, palladium. Lots of people have a love affair with palladium because it's performed well relative to the other metals. But it trades at a 50% premium to gold. I personally believe that palladium here is similar, if not worse, than silver in the early part of 2011. It's richly priced and should correct. Note that I said should and not will. It could very well exhibit a price spike like it did in the years around the turn of the millennium, but I think the odds of that happening are slim. This is a dance that I'm going to sit out. Either way though, it should be fun to watch the action. So there's my outlook, everyone. I'm not excited by values here, but neither am I going to warn people to consider delaying purchases like I did in January. As always, questions and comments are welcome, and I wish everybody a happy weekend.